All right, let's get straight to it. We are looking at Applied Digital, ticker APLD. The U.S. markets are, of course, closed for the weekend, this being Saturday, November 1st, 2025. Applied Digital finished the week at $34.66 per share, closing Friday's session up a solid 2.09% or 71 cents on very heavy volume of over 31 million shares. Now, most people see a stock that is up 344% since January and a staggering 436% over the last 12 months, and their immediate reflexive thought is that they've missed the boat. The expectation is that this is a parabolic, momentum-fueled bubble, just another high beta stock riding the coattails of the NVIDIA stock story, and that its massive run is surely over. But the reality, and this is the critical insight you need to have, is that the market may just be starting to correctly understand what Applied Digital is. The story here isn't the 400% gain that's already happened. The story is the roughly $11 billion in new, long-term secured contracts that now underpin this $9.7 billion company. The tension in that $34.66 price is that the market is still, even after this run, pricing APLD like a speculative, high-risk growth stock, when it is rapidly transforming itself into a utility-like infrastructure provider for the AI age. The expectation is bubble, the reality is long-term contracted utility. For months, the average investor, maybe someone just starting out with online investing or using the Robinhood app for their Robinhood stock trading, has looked at this chart and seen pure volatility. They see a beta of 6.77, which is an astronomical figure. It means this stock moves with wild swinging leverage to the broader market. The common belief is that this is a lottery ticket, a pure gamble on the AI trend. And to be fair, that expectation was built on its past. This company, formerly Applied Blockchain, was a crypto hosting company, a low-margin business entirely dependent on the price of Robinhood crypto assets. But here is the challenge to that thinking. The business model has fundamentally changed, and the numbers are now proving it. The reality is that Applied Digital has successfully pivoted to become a developer of AI factories. These are bespoke, high-performance computing data centers purpose-built for the massive power and cooling demands of AI models. And here is the kicker. They aren't building these on speculation. Just over a week ago, on October 22nd, the company announced a 15-year lease agreement with an unnamed US-based investment-grade hyperscaler. The value of that contract? Approximately $5 billion. This is on top of its existing massive contract with CoreWeave, another AI infrastructure giant. Together, APLD has now locked in roughly $11 billion in predictable, contracted revenue. This isn't a hope story anymore. This is an infrastructure play. The question has fundamentally shifted from will the clients come to can they build these facilities fast enough? That is a much higher quality problem to have. Let's break down the recent action. That 2.09% gain on Friday was a consolidation day. The stock traded in a wide range from $33.55 up to $37.78, showing that bulls and bears are in a serious fight at this new, elevated price level. The volume was high, but it was less than the daily average, suggesting that after the massive spike on the $5 billion contract news, the stock is now finding a new base of institutional support. The fast traders using platforms like Interactive Brokers for their Interactive Brokers trading are likely taking profits, while long-term funds, perhaps those within Fidelity Investments, are trying to build a position. This is why this stock is not for a passive intelligent portfolio or a simple Schwab Intelligent Portfolios account. This is a stock for active self-investing, requiring you to read press releases, not just charts. The macro environment is a two-sided coin for APLD. On one hand, the insatiable demand for AI compute, the same trend that has propelled NVIDIA stock, is the single greatest tailwind in the market. Hyperscalers are in an arms race and are desperate for data center capacity. APLD is one of the only pure-play public companies delivering this specific infrastructure at scale and, crucially, at speed. Their proprietary designs allow them to build in 12 to 14 months versus the 24-month industry standard. This is their key advantage. On the other hand, we have the Federal Reserve and high interest rates. This is the main bear case. Building these AI factories is incredibly capital intensive. It requires a lot of debt. This is an Apple stock which sits on a mountain of cash. APLD is a construction company on a deadline, and every basis point increase in interest rates makes their financing more expensive. This is the execution risk. This is why we see a fascinating contradiction in the analyst ratings. If you're using a basic SoFi trading platform or many investing sites, you might see a strong buy consensus, which is true, but the mean price target is somewhere around $21.50, which is bafflingly below the current $34.66 price. The expectation this creates is that the stock is wildly overvalued, and analysts expect it to fall. But the reality is that the stock's price has moved so fast that it has simply outrun the old consensus. The analysts are scrambling to catch up. The new price targets, the ones issued in the last 2 weeks, are the ones that matter. Needham just reiterated its buy rating with a $41 price target. Craig-Hallum raised its to $39. Lake Street raised its to $37. These firms understand the significance of the $11 billion in secured contracts. The old models are broken because the company has fundamentally de-risked its future cash flows. So what does Applied Digital actually do? As mentioned, its legacy business was crypto hosting. Think of it as leasing a simple warehouse with power hookups. The new business, HPC and AI, is like being a prime contractor hired to design, build, and operate a custom nuclear reactor. The power, cooling, and security specifications are extreme. Their clients like CoreWeave and the new hyperscaler are locking in 100% of the capacity of these buildings, like the Polaris Forge 1 and Forge 2 campuses in North Dakota, for 15 years. APLD is essentially a specialized developer with guaranteed tenants for the next decade and a half. This pivot from crypto is the entire story. Anyone still valuing this as a crypto proxy is using an outdated map. This brings up the big question, and I want you to comment below on this. Given the $11 billion in secured contracts, do you think APLD is still undervalued at $34? Or is the execution risk of the build-out just too high? Let me know what you think. Looking ahead, the future for APLD is binary, but the odds have shifted. The bull case scenario is that they simply execute. They build their campuses on time and on budget. The contracted revenue starts hitting the balance sheet, and the market is forced to re-rate the stock, not as a speculative tech play, but as a high-growth infrastructure company. In this scenario, the stock stops trading with the volatility of Tesla stock and starts trading more like a data center REIT, but with a massive growth premium. The catalysts to watch for are 1. The name of the new $5 billion hyperscaler partner, 2. The next earnings report showing the costs of the build-out and the timeline for revenue, and 3. Any new lease announcements. The demand isn't stopping. The bear case scenario rests entirely on execution and financing. This is the risk that an investor using, say, SoFi Invest or just getting investment help needs to understand. If construction gets delayed, that's a problem. If capital markets tighten and they can't get favorable financing for the next campus, that's a problem. And we have to acknowledge the one counter-signal. A director, Mr. Nottenberg, filed to sell about $510,000 worth of stock at the end of October. Now, in the grand scheme of a $9.7 billion company, this is not a massive dump. It's likely for diversification, but it's noise. It's a small piece of data that goes against the perfect bullish narrative, and we must be aware of it. This isn't the kind of stock you buy in a Fidelity IRA account and check in on once a year. It's an active investment in an individual brokerage account that requires attention. So, to wrap up our look at Applied Digital, this is the definition of a story stock where the story is rapidly becoming fact. The 34.66 closing price reflects a market in transition. The expectation, based on the 436% run, the high PS ratio, and the negative earnings, is bubble. The reality, based on $11 billion in newly secured 15-year contracts, is that this company has almost entirely de-risked its demand side. The bet is no longer on AI. The bet is on concrete, steel, and Applied Digital's ability to meet its construction deadlines. The risk has shifted from demand to execution, and for an investor, that is a much, much higher quality problem to have.